Hey folks, David Frost, my strategic forecast. You're here for another episode of Common Sense Market Analysis. Today is Thursday, May 10, 2018. We're looking at a daily chart of the SPY or SPDR, which is the proxy for the S&P 500. So we have at least a bullseye on our hands as it relates to where we've been discussing the market was going to get to, which is this downsloping trend line that creates a potential another lower high. We don't have that yet because the market pretty much finished strong near the highs of the day. So let's get into the difference between making a market forecast or analyzing the markets and placing a trade. Before we do that, let me just make mention, I want to thank everybody for their participation, making the comments underneath the video. It's wonderful for the entire community. The comments are great. I love the interaction. I love hearing the different perspectives on the market. So thank you very much. Keep up the great work. Keep them coming. Thank you for the likes, and thank you for sharing the video with those you think can benefit from this information. Let's keep paying it forward. I'm paying it forward. Please pay it forward a little bit as well. All right, let's get into the difference between making a forecast and making a trade. When I saw the downsloping trend line, I felt like there was a high probability that the market would ultimately get to that trend line. It would be drawn to that trend line like a magnet. Doesn't matter what all the particular reasons why, everything that I was looking at for the last few weeks, doesn't make any difference. The point is here we are. Now where do we go from here? Now in lies the difference between placing a trade because we think we're at resistance and waiting, having the patience to let the market come to you, to let the market dictate what you do or what you don't do. The biggest challenge that traders have is having patience to wait for the trade. Most of that comes from FOMO, fear of missing out. Whatever the reason, certainly there are tons of traders that struggle with this exact thing, patience getting into a trade. Now, once again today, I got emails all day long. In fact, I got considerably more than I got yesterday about shorting the market at this downsloping trend line. So we got to the target. Does that mean that it's a short trade? Let me tell you what it means. And by the way, I don't mind the emails. I'm not berating anybody for sending me emails. That's not the point. I have no problem helping as many traders as I can throughout these treacherous waters. I told each and every one of you that sent me an email basically the same thing, that we don't have the signal of a trend change. So let's make the distinction between where we are and what can we do about it. So where we are is into resistance. Now, under normal conditions, there's a high probability that even if the market goes slightly higher, we're going to find resistance where we are. Whether it's up a little bit from here, whether it's right where we are, there's a high probability we'll find resistance. However, there's always the other side of the equation, which is there's still a probability, may not be an extremely high probability, but there is a probability that this market continues higher. Does it have to continue to new highs? No, that's not what I'm saying. In fact, if you remember from last night, I said if we begin closing above this trend line, the market's going to have its eye on this 280 level. Don't know that we get there. We may or may not ever get there on this particular move, but what it can do is get halfway home. It can get up to 275 with a bust through or spike through this trend line. So therefore, even though we're at resistance, yes, we are. There's no doubt about it. That doesn't mean the market can't trade higher. The market can always trade a lot higher than people think it can. It can always trade a lot lower than people think it can. So because we're never 100% sure that the market is going to turn around at resistance or turn around at support, we have a good inclination it will, but we need something more. And that's where the signal of a trend change comes in. We may not be able to be the high tick on a short trade. We may not be able to be the low tick on a long trade, but that's okay. We want to be able to be in the trade with as high of a degree of certainty as we can that the trade will work out. And more importantly, we want to be able to get into a trade with a very defined stop loss limitation. Let me just map this out for a second. Let's say the market does go up slightly more tomorrow, but puts in either a reversal candle or puts in even a doji candle. Let's just use that hypothetical example. If it did that, could a trader take a short trade? And if we traded above and closed above, not just traded, but if we closed above the high of tomorrow under those conditions, under that scenario, then that short trade would be off the table. We would have to cover the trade, but we would have something to trade against. So if the market put in a doji candle and then following, meaning the next Monday, we traded down, you have what's called a lead in the position, and you can have your stop loss wherever you want it. You know the trade is wrong if you close above the high of tomorrow's candle under that scenario. That's it. From where we are now, we don't have that signal. That's the issue. The issue is, where would your stop loss be if you took a short trade today? And that's maybe what I should have said to those traders that emailed me about being short the market at this trend line. The question really was, and I wasn't quick enough to think of it, but now I'm thinking of it. The question was, where would your stop loss be? The answer is, I don't know. Where would it be? Because how do I know the market's not going to go up another 20 or 30 handles tomorrow? It may. I don't know that it won't. I don't necessarily think it will, but I realize that it can do that. Let's talk a little bit about the psychology behind why. So I'm not the only one that knows about this trend line. This is a well-defined daily chart trend line that many analysts across Wall Street are watching. So the institutions know that, and they know that normally a lot of traders are going to take a short position anticipating the market turns around at this trend line. It may very well turn around at this trend line. But as you know, the market is designed to trick, trap, and fool as many traders as possible, which is also why we need to be cognizant of the fact that knowing this, they could take the market up farther and essentially screw over the shorts or the people or traders that took a short position at this trend line. They would ultimately cover their short trade thinking they were wrong. And what happened was, under that scenario, if that were to happen, is they didn't have a defined stop loss limitation. And that would be the reason why they would end up getting screwed. I've seen this before. I've read this book before. I've been to this movie before. I'm not suggesting that will happen. I'm just saying I've seen that happen under these type of conditions, and I wouldn't be surprised if that happened. Also, the reason why, back to the same, and I've said this dozens and dozens of times, we're looking for signals of a trend change. If you want to be out on a limb and take the short here, understanding that you're taking on more risk than the trader who waits for the signal, that's fine, as long as you understand what you're getting yourself into. You may be correct. I may be following you into a trade at a less attractive price than you got. That's possible. I'm completely aware of that, but I'm also more comfortable waiting for the signal. And that's really what it boils down to. Here we're down to a 10-minute chart, and you can see here that the market respected that downsloping trend line. Now, is it drawn into the penny of where exactly it should be? Maybe it is, maybe it's not. But you can see the point here where the market traded right up to that trend line, started going sideways, got rejected, gave it another shot, was rejected, gave it another shot. And as far as I've drawn it on this chart, it was not able to close today above that trend line. It's just interesting to watch this type of phenomenon unfold in the market, how it does respect the trend line. And it's not, again, it's not me drawing in the trend line. The market draws the trend line. We're just following the rules that the market is setting forth for itself. Looking at the hourly chart or the 60-minute chart, you know, from the other day, we had the up move, we had the bullish consolidation, we broke out of that position, we talked about that yesterday, and we had the same exact day today that we had yesterday. It was basically a gap and go, and we just traded sideways for the majority of the afternoon, a little bit more today than we did yesterday, but it really was a very similar picture to what it was yesterday in terms of the market. Are we going to have one more of those days tomorrow? Or will this trend line end up being formidable resistance today? We'll see. We're all going to find out. Looking over at the IWM remains very strong. As it relates to relative strength against the spider, we still had a less relative strength. Okay, we did not have the IWM outpacing the SPY on a percentage basis. I think that's interesting. Both markets were up. We can't take away higher prices. They were up on less than average volume. So the spider was up on about 69 million shares traded today. And against an average daily volume of 100 million. And the IWM was up on about 15, 16 million shares against almost 22 million average daily volume. So again, up on light volume, that's okay. We can certainly continue up on light volume. The market's proven that for years and years in the past. That's not the issue. What we have to watch out for is when the market reverses, one of the things we want to pay attention for is the IWM leading the way, are the transports leading the way, and what's volume doing? Do we get a pickup in volume? When we get a pickup in volume and the market's declining, that's another signal. If you're watching it in the midst of a potential trend change signal and you have a significant pickup in volume, that's usually another indicator that you can put in your tool belt. But in terms of the IWM right now, not a lot wrong with the IWM. This daily chart is strong. We're coming up against another run at these highs. You have a high here, you have a high here, and here we are today challenging that area. Are we going to break out in the IWM? Here's the weekly chart, and I'll tell you what, certainly looks poised for a breakout. If we close this week above 158.26, which we are today, we are now, so if we close tomorrow above that level, that's going to be further evidence that we can be getting a breakout in the IWM. I can tell you this, if the IWM is breaking out to all-time highs and keeps going, if it's not rejected at these levels, then the other markets are following suit. They may not be breaking out to all-time highs, but they certainly won't be going down at the same time. That would be very, very unusual behavior. By the way, before we move on to the next market or the next chart, I just want to make mention of something I found very interesting, very fascinating today. Of all the emails I got, there were basically two batches. There was one batch of traders that have not taken the course. They're watching these videos. They're trying to learn. They're doing a good job. They're really intent on getting it right. And they're asking me, is it a short right here? For all the reasons I talked about before. Then there's the other batch of traders that have taken the course. They're aware of the signals. They're aware of what we're watching for and why. They're aware of being able to get into a trade with a very defined stop loss limitation. All the things that I've also discussed in these videos, and they're different emails. I see the market at a particular place, but here's what I'm waiting for. Here's what I think might be happening. Here's what I think can happen, and that's fine. We all have opinions on what we think can happen. That's how we draw opinions on the market, but we let the market dictate where we put our capital. There were two buckets of emails. I just thought it was very interesting. One bucket saying, can I get in? And those are impatient, and that's fine. It's a learning process. Listen, I struggle with impatience in the market just like everybody else. You're not unique to that situation if you struggle with being impatient getting into a trade. We all struggle with that. But the other batch of emails was, here's what I'm waiting for. I hear you. I'm listening. I want to do it right. So here's what I'm thinking. And it was very interesting. There were two different and distinctly different batches of mail. So found it very interesting. All right, put the soapbox away and we'll go over to the VIX. And in the VIX, interestingly enough, so we're obviously down in the VIX. Now we closed today underneath the 200 period moving average, and we're getting into that range where, the VIX could have, a pretty big kind of a fall lower. I don't know that we'll ever get into 1150. That number is a nirvana number. It's like an Uber number. But what I found interesting today, so this is bearish, so we're melting away, and that's fine. But when you look at how much the market was up today, so we had the transports were up almost 1%. We had the S&P 500 up almost 1%. We had the Dow up 0.8%, and we had the NASDAQ composite up 0.9%. And we had the VIX down 1.5%, less than 1.5%. On a day when the market's up 1% across the board, we generally, not always, but we generally see the VIX down more than it was down today. So is that trying to tell us something? Is it telling us that we're coming up into a resistance zone in the market? And even if we do trade slightly higher, the bet is really that we're going to have that next leg down, whether it's from where we are today or a few points higher, maybe even 20 or 30 points higher in the S&P. Is that what the VIX being able to kind of hold up near the flat line today, is that what it's telling us? I'm not 100% sure, but it's certainly a puzzle piece that I need to put on the table, because I do take notice when the VIX is basically closer to the flat line than it's not, in my opinion. 1.5% in the VIX, not a big move, 19 cents. So I want to take notice of that. I need to put it as a puzzle piece. It's a clue. It's a piece of evidence. So I want to note it. So going over to the transports, a nice strong day in the transports, up almost 100 points today, almost 1%. We traded into the 100-day moving average. Where's the line in the sand, or at least the current short-term line in the sand for the transports? You see this breakdown candle? The high is 10,684 and some change. If we close above that level, that's going to be a signal that higher prices are likely coming in the transports. If you go over to the weekly chart, and this is something that we need to pay attention to for tomorrow, if we're going to push higher tomorrow, if that does take place, you see where we are relative to the 20-period moving average. That's item number one. Then if we did push higher, where do we close as it relates to these former highs? That'll be interesting, because again, we could be just at the top end of a bearish channel, a bearish long duration channel. We go up to the top of the channel, and then what do? We go down to the bottom of the channel. One of these times, we will break out to the downside or break out of this channel on the upside. Is it this time, or do we get stopped short at the top of the channel? So when you look at the different time frames, look at the weekly chart versus a monthly chart versus an hourly chart, you get a completely different picture. And that's why, it's precisely why we look at different time frames. I want to be able to either confirm that my thinking and what I'm seeing on a daily chart is correct. And in this case, I can see what I'm looking at in the weekly chart very clearly. I see this is just a long-term back and forth channel, and that's fine. I can see it clearly on this chart, but that's why we look at different time frames to make sure we either confirm what we're seeing on another time frame, and it's okay, by the way, to be short-term bullish while we're longer-term bearish. We can see that maybe the market just wants to trade up to the top of the channel. That's short-term bullish. When we get to the top of the channel, what's the likelihood that we're going to bust through the top of the channel? What's the likelihood we're just going to cut through it like a hot knife through butter? Well, obviously it depends on a lot of what the other markets are doing at the time, but it's just a rhetorical question. We have to see what's going on when and if it actually does get up to that level. Tonight we'll take a quick look at the triple Qs. The reason why I want to look at this chart is because obviously you can see a tremendous move over the last several days. So there's a couple of things going on here, and we'll use this chart, and it looks very similar to the spider chart, but since we're on the Q chart, what I'll do is point out something very interesting from the last important pivot low, and this is something that's gone over in detail in the course at Lazy E Mini Trader. We're getting into a specific period of time where we would be looking for a signal of a trend change. So think about this for a second. On the daily chart of the SPY, we're into a downsloping trend line where we should be looking for resistance. Now I look at the Qs, and also the same applies on the spider chart. We're getting into an area from a timing perspective, and keep in mind, and this is discussed in the course, time is more important than price as it relates to the markets. So we're getting into a period of time where we would be normally looking for signals of a trend change. Doesn't have to happen. It's not going to happen 100% of the time, but this is when we would start looking for it, beginning tomorrow, for example. So that's another thing. And then a third item is we have a gap fill right around 171 on the triple Qs. So the question is, are the triple Qs going to blast off tomorrow morning, fill the gap, and reverse? Is that possible? Yeah, that's a possibility. I'm looking at that as a possible scenario. I'm looking at tomorrow as a possible volatile day. Are we going to get a volatile Friday, or are we going to get a Friday floater, a sleeper Friday? I think we're going to get a volatile day. I think there's a possibility. And again, I'm just projecting something here. I'm not forecasting this will happen. I'm saying I won't be surprised if it does happen. Higher prices early in the day and a potential reversal tomorrow. It's on the table. I'm looking for it. If we see it, I'm able to act on it. If it doesn't happen, I'm not acting on something that I think might happen. So I just want to make sure that we're all clear on this. When you look at all the things I'm looking at and we put together the puzzle pieces, I could see something like that unfolding tomorrow, specifically when we look at the Qs. I could see the Qs filling that gap, and I can see that gap being resistance. Pretty interesting and fascinating stuff. You can see we're at an inflection point in the markets. We're at a very critical juncture in the markets as far as I'm concerned. XBD, Broker Dealer Index. There's a reason why I brought this up today, not because it was up 21 cents. It's basically flat. What I want to point out is you do have a pseudo doji candle on the financials. That's interesting. Where did it occur? It occurred at a double top. Okay, so that's also interesting. We're at a potential resistance in the spider. We're near a potential gap fill in the Qs. And just so happens the financials potentially are struggling at a double top area on the daily chart. So that's interesting. So you can see the more charts we look at, the more puzzle pieces we get, the more data we have as this picture starts to take shape. XLF. Now, the XLF had a better day than the broker-dealers did, but we traded into the 100-day moving average, and we did, by the way, close above this breakdown candle. That's interesting. Let me get my pen out. This breakdown candle, we did close above that by a couple of pennies. That's not an accident or a coincidence. They meant to do that when it's by a couple of pennies. The high was 28.24, and we closed today up 4 cents above that 28.28. But keep in mind, you have another breakdown candle right here. So, is this one important or is this one important? Well, they're both close to each other, so you also have a gap fill right up here. So you can see where the XLF could certainly push higher if the market got a spike tomorrow. I could see that happening. We'll just have to see. Nothing conclusive on this chart. How about the SOX? The SOX is a great indicator for the tech sector. Look at the SOX rally today, up 1.8%, up 24 points. Look where we are. We're getting above this double top area right here. Can we sustain above that level tomorrow? We'll see. Be interesting to see. This is a make it or break it number. Are we making a run for that level, that breakdown candle? We may be. Very strong day for the SOX. This is an indicator that the tech sector is strong. The more data you take in, the more conflicting information you see, which goes right back to the same thing, which is why we look for signals of a trend change before taking a position when a market is in a state like it's in right now. So we want to be taking trades, making trades with the highest degree of certainty that we can. That's the only way that you can effectively be successful in this business. Gold. Now we have an update in gold. So gold is now heading for the moving averages. It's pretty crystal clear. We're going to head at least for the 20 moving average, not that far away, but we should see into the convergence of the 100 and the 50 period moving average right around 1330 to 1332 in that zone. This is where gold wants to go. You just couldn't see it coming the other day. This was basically as clear as mud over the last, not only even several days, just last several weeks. It's been very choppy, very difficult to get a read on the gold market, very difficult to trade, no doubt. I haven't been trading gold. Very difficult one way or the other. Crude oil continues its melt up. Is it putting in a pseudo doji candle today? Maybe it is, maybe it's not. We're all of a sudden even a little far extended from home base or the 20 period moving average. So regardless of whether we have to go sideways for a period of time again and then have another leg higher, either way, I think we're headed right to the zone we keep talking about, in between 73, 74, maybe even as high as $76 to $78 a barrel. I think the last zone I gave was $74 to $78 a barrel. That's the hot zone. That's what I'm calling it, 74 to 78. Again, we'll do the same thing with crude oil that we're doing with the Spider or the S&P 500. We're waiting for signals of a trend change. That's why I don't care if it turns around at 74, 5, 6, 7, or 8. Doesn't make any difference. Wherever it does, I will be able to participate as long as I can identify, and hopefully I can, identify the signals of a trend change. And that's what we'll be looking for. And with that, folks, it's everything I wanted to and intended to discuss tonight. So I'm going to give it a wrap here. I'm David Frost, my strategic forecast. Thanks for tuning in for another episode of Common Sense Market Analysis.